Okay, good evening. This is Professor Mayer. I thank you very much for your attention and your participation this evening. This is our sixth session, and we are plowing through the book fairly quickly, and I certainly appreciate everybody's hard work in regards to assignments and so forth. So let's just kind of jump into the material. We have a lot of material to cover, and the material is going to be related to Chapter 13, Property, Plant, and Equipment, and we're going to go through Chapter 14, which is Accounts Payable primarily, and Chapter 15, which is the equity section. So we have a lot of material that we need to cover, and I really want to use this time to essentially walk through the material as it relates to the audit process. Now, let's just kind of step back and make sure that we understand sort of where we are in the process. So we've gone through, we've understood the process, and the process is really driven by this audit risk model, where we are attempting to manage audit risk through this process of determining the inherent risk and the control risk. Based upon the inherent risk and the control risk, we are defining the risk of material misstatement. Based upon the risk of material misstatement, we determine the nature, timing, and extent of our audit procedures. Now, these audit procedures are all substantive if we are doing just a financial statement audit. If we're doing the integrated audit of financial statements along with the audit of internal controls over financial reporting, some of this further audit testing is specifically related to internal controls. But in any event, what we do then is we are auditing based upon management assertions. Assertions are these explicit or implied assertions coming from management in regards to the items specified in the financial statement, account balances, classes of transactions, and otherwise. So this is really the basis. Now, from a functional perspective, what we do as auditors is we audit based upon processes. So we've talked about the revenue process in our last discussion primarily. Now we're going to talk about certain processes as well as classes of transactions and account balances. So one of the things that we want to focus on in Chapter 13 specifically relates to property, plant, and equipment. And of course, corresponding to that is going to be our depreciation or depletion method, depending upon what it is that we have. So what do we know related to property, plant, and equipment? Well, these are tangible assets with a service life of more than 1 year that are used in the operation of the business and are not acquired for the purpose of resale. Okay, so I don't want to really go into much of this detail. Much of this stuff you should have covered in intermediate accounting, but what we're really focusing on, we're looking at property, plant, and equipment. We obviously know that property, plant, and equipment are these items that are purchased for the benefit of operations, but for the benefit of operations over an extended period of time. So we have an asset. This is a resource. As we consume this resource, we have an expense. Well, this expense is depreciation expense, and of course we have the contra asset. So what we have here is, what we're looking at is from property, plant, and equipment, where we have three major subgroups. Land, of course, the unique feature related to land is the fact that land is not depreciable. And hi, Natalie. And we have building, machinery, equipment, and land improvements. These are depreciated maybe 5, 10, 30 years, depending upon what we have. And then the other category is going to be natural resources. And this is where we're dealing with depletion. So let's say that we have an oil well, or we have a where we're doing mining of coal. Whatever it is we are essentially extracting out natural resources from the ground, and those natural resources create what we call a depletion. A little bit different than depreciation, but basically the same concept. The objective related to our audit of property, plant, and equipment is to understand the inherent risk and the control risk. And again, why are we looking at inherent and control risk? Well, we're looking at inherent and control risk because this is what is defining the risk of material misstatement. So we use the understanding of the client and its environment to consider inherent risk, including fraud risk related to property, plant, and equipment. So the idea is, what is the assets that an organization has? Are these assets that have very little value outside the organization, or are these assets that are highly transferable and easily stolen, where people could take the material and leave? So this is the inherent risk. And again, when we talk about inherent risk, we're talking about the nature of what we're looking at. So the nature of this property, plant, and equipment, is it such that it is a target for fraud or a target for other types of issues? And then what we need to understand is the internal controls over property, plant, and equipment. So we're primarily focusing here on, based upon these inherent risks, what is management doing to mitigate this risk? And this is really what we're talking about related to the internal controls, the control risk. And again, control risk and the inherent risk essentially is going to define the risk of material misstatement. So our objectives, as we are looking at the risk of material misstatement, is, once we've done this, is that we want to design a test of controls and substantive procedures that include existence, completeness, verification of transactions cutoff, determine the client has rights to these assets. And someone came in, and hang on here. Okay, I turned that off. Okay, so very good. Okay, so I think we're back in action. And then we want to determine the nature or the presentation and disclosure. So again, just kind of think about what this slide is telling us is, based upon the risk of material misstatement as defined by the inherent and the control risk, is we are designing test of controls. And we think when you see this phrase here, it's very important to understand, when we see the phrase test of controls and substantive procedures, is what we are talking about is when we are doing this integrated audit of internal controls and financial reporting. If we're only doing an audit of financial reporting, is what we're looking at are only our substantive procedures. Substantive procedures are where we measure monetary misstatement. But in any event, what we're looking at is we're looking at existence and completeness. So these are complementary issues here. So what we're saying is, what is being reported as property, plant, and equipment? Does it exist? The other piece of it is everything that is property, plant, and equipment reported on our financial statements? And this is our completeness. So we have the two issues here, existence and completeness. Cutoff, obviously, are these transactions at year end. Rights is we want to make sure that we have the rights to this property. So maybe we have assigned these as part of maybe a loan agreement, or maybe these are items that are in our possession, but they have been lent to us for whatever reason. And then finally, we're looking at valuation. When you think about valuation, especially in a cost mechanism, is what we're really looking at is, are we valuing the assets appropriately? And how do we do this? Well, we're doing this by managing the allowance for doubtful accounts. Presentation and disclosure is really talking about the notes related to the financial statements. Okay. So let's continue on here. So what we're looking at is just a comparison of current versus non-current assets. So in the current assets that we've talked about, accounts receivable, we'll talk a little bit about accounts payable later today, is these are transactions and account balances that have a high turnover. So in these cases, what we're looking at the approach is to audit the balance. Property, plant, and equipment, intangibles, long-term debt, owner's equity, low turnover, so we're not doing transactions on a continuous basis. And what we're looking here is the changes in the accounts. So if we have audited, as an example, the building, so we know that it's a legitimate building, we know we have ownership of it, we have established a depreciation table, and so forth. So that's good to go. So what we're looking for in this year's audit is any changes, maybe purchase or sale of this property, but also maybe changes specifically to the actual asset. Maybe we've done some improvements, whatever the case may be, but what we're looking for are changes in these long-term assets as opposed to the actual account balance. So controls over plant and equipment. We're looking at the use of plant and equipment capital budget, maintenance of a subsidiary ledger, a system of authorization, analyses of variance of budget expenditures, a statement of policy distinguishing capital and revenue expenditures, a requirement to purchase of plant and equipment are subject to normal purchasing, periodic physical inventory, a system of retirement authorization, and let's just kind of go back here. So let me just sort of talk about a couple of these things from a very practical perspective. So what you notice, and I think this is absolutely important, is we need to understand that a capital budget is critical in terms of our analysis of what's actually taking place. A capital budget essentially is management's way of managing the process. And in fact, a budget is a very good control process. So as we are auditing, one of the first things that we want to do is we want to understand the budget, how it's put together, and then begin to understand what these budget variances are. Okay. Maintenance of a subsidiary ledger. What we're saying here is that we need to separate this plant and equipment in such a way that we can actually manage it. And depending upon the organization, this may be quite an arduous process. I worked for an organization that had well over 100,000 pieces of capital equipment, as well as buildings and so forth, and projects and all these things. And managing this was, in fact, the role of a specific department. And they did things based upon this process. We clearly need authorization, so this again goes back to the budget process. Depending upon the size of the capital equipment, it's very possible that there may be a capital equipment subcommittee of the board of directors. All these things essentially becomes critical in our understanding of the controls. When we're looking at how we're actually documenting this, what we're looking for is a summary analysis that emphasizes changes during the year under audit. Analysis of additions and retirement, analysis of repairs and maintenance of expense, and the tests of depreciation. One of the things that becomes very sort of simplified related to depreciation is, let's assume that there's not much that is actually changed related to the asset. Well, if we established a depreciation table last year or several years ago, basically this becomes the template that we can then audit from as we're going through the process. So again, looking at changes, if there are no changes, then basically we know exactly where we need to go. Okay, the initial audit, begin with balance, substantiated by a review of the predecessor's working papers. So if there was a predecessor auditor, it's actually very important that we understand these beginning balances, especially as it relates to depreciable assets, because there may be something there that maybe costs $1 million, but it's only being reported on the balance sheet of $700,000. Well, We're assuming this is the accumulated depreciation, but unless we understand the mechanisms of this depreciation, which will be a part of the permanent files, is we don't really have a good understanding of this beginning balance. So anytime there is a change in auditor, this kind of information becomes very important. If not previously audited, a complete historical analysis of property accounts is needed, a thorough review of all major charges and credits. We understand the client and its environment to consider inherent risk, including the risk of fraud. Okay? And one of the things I want you to sort of understand related to these steps, these are the standard steps. And whenever you see understanding, gaining an understanding, we know that we are looking at the planning stage of the audit, and we understand that we are focusing on inherent risk. Whether we're looking at property, whether we're looking at accounts receivable, whatever, is what you see here as the steps, is these are the steps. So we understand inherent risk, primarily focusing on this understanding of the environment. We obtain an understanding of internal controls, so we are understanding the control risk. Based upon the inherent and the control risk, we assess the risk of material misstatement and design further audit procedures. We perform further audit procedures, test of controls, the nature of the controls, if necessary, revise the risk of materiality based upon the results of the test of controls. So D is really focusing on, are we doing an audit based upon this whole concept of the internal controls over financial reporting. We perform further audit procedures, substantive procedures. Think about substantive procedures. Substantive procedures is where we are measuring monetary misstatement. So in the measurement of monetary misstatement, this is the basis of our opinion of the financial statements. We obtain a summary analysis of changes in property. We vouch for these additions. We make a physical inspection of major acquisitions of plant and equipment. We analyze repair and maintenance. We investigate the status of property, plant, and equipment. We test the client's provision for depreciation, investigate potential impairments of property, plant, and equipment, and investigate the retirement. Okay, so essentially what we're looking at is all these things really relate to account balances of the pre-depreciated and then the accumulated depreciation and the net value of our assets. And as we're looking through these, what we're looking at is we're looking primarily at changes. And one of the things that becomes very difficult, again, depending upon the organization, depending upon the type of equipment that they use, is identifying these items that have actually been retired. In my experience, has actually been somewhat problematic in terms of identifying these. Okay, so we're continuing with the further audit procedures. Examine evidence of legal ownership. Well, if we're looking for legal ownership, we are testing the management assertion of rights. So do we have rights to those assets? We review rental revenue from land, building, and equipment owned by the client but leased to others. Examine the lease agreements leased to and from others. Perform analytical procedures and evaluate the financial statement presentation and disclosure for plant assets and related revenue and expenses. So when we think about these analytical procedures, I want you to sort of focus on the fact that we probably are going to be sort of devising some of our own analytical procedures. Maybe the percent of depreciation that is charged against the asset, compared that to prior years, really should be the same, especially if we're using a straight line depreciation. We certainly would use a number of analytical procedures to really determine whether or not what we're reporting as our property, plant, and equipment is in fact appropriate. If we're looking at lease agreements, we're probably trying to focus on or determine whether or not these leases should be capitalized or should they be operating leases. Same thing with any of the rent that we're collecting from these assets. Okay, potential misstatements, very interesting. What we're looking at the top here is a description of the misstatement, examples, and then the internal control weaknesses. So what we're attempting to do here is we're attempting to focus on what is taking place within the organization over property, plant, and equipment as it relates to fraud or errors, or misstatements due to fraud or errors. So the first description of the misstatement, I'm not going to go through all of these, is the misstatement of the acquisition of property, plant, and equipment. An example of a fraud would be the expenditure for repairs and maintenance recorded as property, plant, and equipment really is in fact an expense. Well, this is absolutely going to be related to the issue of organizations trying to manage their earnings, and they're essentially taking these expense items and including these as capital items with the idea they're moving these off the income statement and making these depreciable items. Well, accounting principles basically dictate that if it's repair and maintenance, this is an operating expense. One of the control weaknesses is undue pressure to meet earnings targets. There's many examples of organizations that use these types of fraudulent behaviors, and they've used these types of fraudulent behaviors essentially to manage the earnings and to basically increase net income by extracting out legitimate repair and maintenance expenses. And from an analytical procedure, certainly one of the things that we want to look at is repair and maintenance as a percentage of fixed assets. Compare that from year to year. If that drops significantly, or if it seems unreasonable given facts and circumstances, this may suggest that the organization is in fact taking these expenses and then moving these to capital items with the idea of keeping these off the books. We may purchase equipment erroneously and charge this to operations as opposed to fixed assets. I've seen this. This actually is not a common problem, or not an uncommon problem, and it really takes controls at the department level. It takes controls at the purchasing level as well as the receiving level and accounts payable to make sure that these items are actually reported appropriately. Okay, now keyword here is substantive procedures. Substantive procedures, again, is where we are attempting to measure monetary misstatement. So in substantive procedures, we are measuring the monetary misstatement as it relates to our account balances for property, plant, and equipment. We want to obtain a summary analysis of the changes in property. This is looking primarily at the objective of valuation. We want to vouch additions during the year, make physical inspections of major acquisitions. We're looking at existence, occurrence, rights and valuation and allocation, and cutoff. Analyze repair and maintenance, valuation issues, investigate the status of property not in use. Maybe these items are not in use and they've been disposed of, but they're still on the books. Well, we need to figure these out. Test the clients for provision for depreciation, a valuation issue, and so forth. So I think you get the idea of, as we're looking at these items, is we are looking at monetary misstatement. So let's talk a little bit about vouching, and then I want to focus on the next chapter, because we got 3 chapters that we want to cover in this small period of time. Vouching is, what we're looking for is we are reviewing changes during the year in construction and process and examining supporting work orders, both incompleted and closed. Trace transfers from the construction and process account to the property account, observing the property of classification, the propriety of classification, determine that all completed items have been transferred, and then on a test basis, vouch purchases of property, plant, and equipment to invoices, deeds, contracts, or other supporting documents. So when we're going vouching is we're looking at what is on the financial statements and going back to what are the supporting evidence. So we're looking for existence. Vouching 2, investigate all instances in which the actual cost of the acquisition substantially exceeds the authorized amounts. Investigate fully any debits to property, plant, and equipment not arising from the acquisition of physical assets. Determine the total cost of any plant and equipment purchased on the installment plan. This is reflected in the asset accounts that the unpaid installments are set up as liabilities. Okay, let's now jump to our next chapter. And our next chapter is chapter 14. And what we're focusing on here is accounts payable. Okay, so this essentially is the completion of the purchasing cycle. So in accounts payable, what we're attempting to do is we are attempting to pay based upon what was received and what was ordered. So we have this, we call this three-way match, where we're looking at the invoice, we're looking at the receiving report, and we're looking at the purchase order. If these all align, this is probably going to be a legitimate order, and accounts payable then will then approve this for payment. Okay, accounts payable really are for the purchase of goods and services for the day-to-day ordinary course of business. Okay, so these are short-term obligations, acquisition of merchandise on credit, receipt of services such as advertising and repairs, invoices and statements from suppliers, and also some accounts payable interest-bearing obligations are not included in accounts payable. They are included as bonds, notes, and so forth. So when we talk about accounts payable, there may be short-term notes payable, but we want to separate out the accounts payable because the accounts payable is the area where we are paying for goods and services for these items that we're using on a routine basis, ordinary basis related to the organization. Accrued liabilities, sometimes called accrued expenses, salaries, interest, rent, and so forth, accumulated over time, and management must take accounting estimates at year end. Note that if management does not make such an estimate, no entry will occur since the related transactions may have occurred 6 months ago. Well, these estimates in many cases are going to be mathematical calculations. So the accrued liabilities, so as an example, if you pay a long-term debt, the interest on July 1st every year, well, we are accruing the liability for that interest expense from January 1st to December 31st. Well, that's not an estimate. That's an absolute calculation. But the idea of what we're saying here is that if management forgets to make that calculation, well, there's not going to be anything that would suggest that it's missing. So there's not going to be an incomplete transaction in the accounting system because we're essentially creating an entry for this period of time. So we're doing the accrual method of accounting, and if we forget to do this, then it's very possible that it's going to be forgotten. The objective for audit of accounts payable and purchasing, so you notice how accounts payable and purchasing really dovetail together because they really are part of the same process. They're part of the purchasing process. Is we need to understand the client and its environment to consider inherent risk, including fraud risk related to accounts payable, obtain an understanding of internal controls over accounts payable, So again, everything that we've talked about in the last chapter relates here. Inherent risk, understanding the client and its environment. The control risk is what are the controls over accounts payable. We're then going to assess the risk of material misstatement and design tests of controls and substantive testing that tests the existence of accounts payable, establishes the completeness of accounts payable, verifies that cutoff transactions are done appropriately, and determine that presentation and disclosure is made in an appropriate manner. Concerns related to accounts payable, possibility of understatement or omission of liabilities. This would exaggerate the financial strength of the organization, conceal fraud, and accompanied by an understatement of expenses and an overstatement of net income. So whenever we think about the financial statements, and we think about it from the perspective of a fraudster, well, someone that wants to perpetrate fraud is going to do two things. Is they want to overstate assets and revenue, and they want to understate expenses and liabilities. So even though we're looking at under and overstatements in all of these accounts, from a fraud perspective, we want to think about it from the perspective of where is this fraud going to be perpetrated? And it's clearly going to be perpetrated from the perspective of attempting to overstate revenue and understate the liabilities, because this is the people want a higher net income. They don't necessarily want a lower net income, although the caveat to that is there's this concept that we call a big bath. Well, a big bath is essentially occurs when the organization is expecting a loss and they're saying to themselves, hey, wait a minute, we're going to be losing $1 a share. Well, why don't we just pump that up and make it $2 a share, and then we can tap into those reserves later on and give the illusion that in fact we're growing faster than we are. So the reason I point this out is that when we're looking at fraud, it's very important to understand that we're generally looking at fraudsters that are attempting to overstate revenue. However, there is a legitimate concern on the flip side of this, what we call a big bath, where we're essentially overstating our expenses, creating these reserves that we can tap into later on. So we are looking at both sides in terms of completeness and existence. Control, segregation of duties, the approval of purchase orders, numeric controls over purchase orders and receiving. Very important that the organization has a control from the purchase requisition. Purchase requisition comes from the department. The department should not be ordering on their own. They should be ordering through the purchasing department. The purchasing department is responsible for managing the list of vendors. They're responsible for developing the pricing and the catalog for these vendors, and obviously the pricing. And they're responsible for the ordering. Now, once it's been ordered, it's going to be received. So receiving should be receiving the product and documenting what they actually received. Well, then when accounts payable gets the invoice, they are doing, again, what we're talking about is a three-way match, and they're matching the invoice that's coming from the vendor to the items that were received, which is based upon the receiving report, and what was ordered, and the pricing that was established in the purchase order. So we have these three items: purchasing, receiving, and invoice. And if they match, then the accounts payable department will then approve for payment. Now, accounts payable, again, as another segregation of duties, is not going to be responsible for actually sending the check out. This check is then going to be going to be distributed by the cash disbursement department, which is probably going to be a subset of the treasury department. So we have within the purchasing cycle is very specific segregation of duties. And we want to make sure that these cross over in such a way, and there's this line of demarcation in such a way that one person doesn't have the ability to control two or more processes within this. So we're looking at purchase orders, the receiving report, vendor invoices, vendor statements. Now keep in mind that in a electronic environment, so most organizations are moving towards what we call an ERP, Enterprise Resource Planning format, where everything is in the same IT system. Well, in an ERP system, essentially what we have is we have all the documentation. So what accounts payable can actually do electronically is do this three-way match between receiving, purchasing, and the invoice. Okay, so I'm not going to go through this, but the idea here is that what we want to do as auditors is we want to document the process. An appropriate way to document the process is through a flow chart. We can also use narratives, and we can also use questionnaires. But I would suggest that the highest quality documentation of our understanding of internal controls is the flow chart. In the working papers, we want a lead schedule for accounts payable, the trial balance for various types of accounts payable, confirmation requests for accounts payable, and the listing of unrecorded accounts payables. So when we're looking at potential misstatements, examples of this, you see the examples are listed as either fraud or errors, and some of the internal control weaknesses that create problems and essentially gives the organization. Okay, so so what we have here is, as an example, and we're not going to go through this completely, but the inaccurate recording of a purchase or disbursement. A bookkeeper prepares a check to himself and records it having been issued to a major supplier. Well, this is obviously a segregation of duties issues, is the bookkeeper really should not have control over two processes. So in this case, he or she is controlling both the approval and the check distribution. Okay? So from an error perspective, is a distribution is made to pay an invoice for goods that have not been received. Or maybe we're actually paying the invoice twice. Okay, so there's a lot of things that we want to consider as we are going through accounts payable. Risk of material misstatements, we need to have controls against misstatements. Auditors found serial numbers, receiving reports are prepared, serial number vouchers are prepared, payments are made promptly, immediate recording in accounts records, independent employee reconciles the subsidiary to the general ledger. You notice that we use these serialized numbers for receiving, for vouchers. By the way, a voucher is this internal document that we have when an invoice comes in. The voucher essentially is created to basically manage internally that the invoice coming from the vendor. Okay, but they're serial, so they're numbered sequential. So 1, 2, 3, 4, 5, and what we're doing as auditors is we're identifying the voucher numbers that were prepared during this period, and we're looking for duplication, we're looking for missing numbers, we're looking for things that would suggest that in fact there are things that were processed that were not processed appropriately. Okay, accounts payable audit steps. Let's go through this and then we'll jump over to the next chapter. And so we understand the client, inherent risk, obtain an understanding of internal controls, And based upon inherent risk and control risk is we determine the risk of material misstatement. Perform further audit procedures. If this is an integrated audit, we are doing test of controls, these further audit procedures. Verify a sample of postings to the accounts payable control account. Vouch to supporting documents, a sample of postings to selected accounts in accounts payable. Test IT application controls. If necessary, revise the risk of material misstatement based on the results of the test of controls. Perform further audit procedures from a substantive perspective is we prepare a trial balance or obtain or prepare a trial balance of accounts payable as of the balance sheet date and reconcile with the general ledger. Vouch balances payable to selected creditors by inspecting supporting documents. Reconcile liabilities with monthly statements. Confirm accounts payable directly with the vendors. When we use the word confirmation, confirmation is always a substantive procedure, and in this case what we're doing is we're going outside the organization and vouching this information from the outside party. So the last time we talked about confirmations of accounts receivable, here we're talking about confirmations of accounts payable. The final item is we're looking at analytical procedures. We're searching for unrecorded accounts payable. Maybe we're looking for items that were paid, but with no direct correspondence to where this is coming from. Perform procedures to identify accounts payable to related parties. Related party transactions obviously are going to be excluded in the consolidated financial statements. So we want to make sure that we're actually understanding the to and from these organizations. And then evaluate proper balance sheet presentation and disclosure. Substantive procedures, when we're looking at substantive procedures, is we are measuring monetary misstatement. So we've basically have talked about this, but this has the objectives related to the audit that we're focusing on. Okay, in our last couple of minutes, what I want to do is I want to focus on Chapter 15 and we'll talk about auditing debt and equity. And this is going to be a little bit different in the sense that we're looking at transactions that occur not very often. And we are essentially going to be focusing on the substantive procedures as opposed to reliance on our test of controls. Long-term debt, substantial in amount and often extends over a long period of time, maybe 20 years or more. If you have a mortgage, that may be a 30-year mortgage. Examples may be debentures, secured bonds, and notes. Formal documents creating bond indebtedness is indentured or trust indentured. May contain restrictive covenants. In any event, what we need to understand is the long-term debt and review the documentation related to this. So we need to understand the covenants, any restrictions as to use or as to maybe maintain a specific equity or other analytics related to financial performance. We need to understand that. But in any event, all of these long-term debt documents are going to be a part of our permanent file because we're going to be referring to these month or every year. Okay? In the financing cycle is activities of the companies designed to obtain capital funding, involves the issuance and repayment of debt and equity, the payment of interest and dividends. The primary concern is the proper authorization by appropriate officials in the company or by the board of directors. So what we're looking for is if there's a new bond, this obviously needs to be authorized. If there's new stock, this needs to be authorized. So we're looking for authorization by the board of directors. Okay, so from a control perspective, is what we're looking at, obviously, is the inherent risk and the control risk. We need to understand the client and its environment related to fraud, related to this debt. Obtain an understanding of internal controls, assess the risk, and once we assess this risk, we determine our substantive testing. And in our substantive testing, we're looking for existence and occurrence. We are establishing completeness, verifying the cutoff, determine that the client has obligations to pay the recorded debt, establish the proper valuation, and there's going to be very specific presentation and disclosure issues related to this. Similar to accounts payable, we need to understand that debt is a major potential audit problem. We need to understand the disclosure of debt. Auditors must determine whether the company has met all the requirements and restrictions of the debt agreement. Internal controls related to bearing bonds. Authorization, use of an independent trustee, interest payments on bonds and notes. So essentially what we're looking for is we want to make sure that any long-term debt was authorized. We want to determine if there is an independent trustee, and we need to establish a payment system, and we're going to probably set up our own present value table, determine when it's paid, any accruals at the end of the year, and frankly we can set this up one time, and assuming that there's no changes to this bond, this table then is going to be used year after year. Are amounts of new debt authorization appropriate? Is an independent trustee used? Does the company monitor compliance to debt provisions? So what we're looking for is a copy of the debt restriction, extract listing of the restrictions placed. The current working papers includes an analysis of the ledger accounts, related accounts for interest, and the discount. So let's talk about a couple of things in terms of our substantive testing. And again, this is going to be the primary focus as we're looking at this, because what we're looking at is we're looking at monetary misstatement. And again, we're focusing here on debt. Obtain analyses of interest-bearing debt and related accounts. Payments or other disposition of notes listed as outstanding. The propriety of individual debits and credits can be established. The amount of year-end balances of the account is proved through the step-by-step examination of all changes in the account during the year. Misstatements may be due to improper reporting of debt, incomplete reporting of the debt, or improper authorization or amortization. So again, we basically have talked about this, is once we establish the debt and we have the documents, we understand any restrictions to it, is then we basically then put together a table. And this table is going to be, okay, let's say we issued the debt on June 1st. Okay, so we know what the cash payment is going to be every year. We know how much is going to be accrued as related to premium or discount. We know what's going to be accrued at year end for interest payable. We know all of these things. We're going to set this up front. And the next year that we do this, there's really nothing to do other than to determine if there were changes to the bond. And if there weren't any changes to the bond, then it's pretty straightforward in terms of what we need to do. Confirm interest-bearing debt. Confirm by the financial institution. Include with standard confirmation for cash. So essentially we're looking for third-party confirmation of this debt from the bank wherever this is being held. We confirm date of origin, due dates, unpaid balances, so forth, and confirm the bonds with the trustees. We vouch the borrowing and repayment transactions, basically what we've been talking about here, perform analytical procedures, Analytical procedures are simply validating the fair or the present value calculations that the company is using in terms of allocating debt, allocating the percent of premium or discount related to the bond. Test computation of interest expense, interest payable, amortization, basically what we've been talking about. Evaluate compliance with debt provisions. The compliance with debt provisions is probably going to be the hardest part related to this audit, because this is where it's really creating risk for the organization. So the idea is that if the organization is not in compliance, maybe they have too much expenses or whatever the compliance rules are, well, the bondholders can essentially recall the debt or do something that is going to impair the organization. So when you're looking at debt compliance, we're really trying to look at this from the perspective, is there additional risk related to the organization? If the bondholders come in and demand payment, well, that's going to create a problem, especially if we're not maintaining the appropriate provisions, because we're not creating enough cash or whatever these provisions are. So this is really where the risk is related to the debt. We want to review notes payables paid or renewed after the balance sheet date. Perform procedures to identify notes payable related to for related parties. Again, if we have related party transactions, these need to be removed. Send confirmation letters about financing agreements, a separate confirmation letter to verify the details of these financial arrangements. So we're looking at lines of credit or contingent liabilities. Evaluate the financial statement presentation. And then finally, what we're looking at in the financial statement presentation is the adequacy of it, the allocation of the current portion of the long-term debt, restrictions imposed, and any unamortized bond premium or discount. A lot of this stuff is we're going to be able to calculate based upon this whole concept of just the present value calculations. Okay, so this is an example of a confirmation letter, and I'm not going to go through this, but essentially what we're trying to do is we're trying to confirm this. Now, the issues related to timing of debt. We do have a small number of entries. The end of the year, we often wait until after the balance sheet date for many of these procedures. We test for unrecorded liabilities, can't be done before the balance sheet date. And the evaluation of compliance is going to be a year-end event. Test of interest rates, interest expenses, these are all calculations, but they're not going to be reported on the financial statements until year-end, so it doesn't make any sense to calculate it prior to year-end. And then investigate the notes payable paid at year-end or not paid. So the idea is that if you have a debt that's due January 30th and now it's the middle of February and you're doing your audit, well, you created that liability at year-end, but you haven't paid it, so what does this mean? And these are the things that you need to think about as you are working through this. Okay, just a couple comments related to owner's equity. We clearly are going to be reporting on our capital stock accounts, not only the common and preferred stock, but also the additional paid-in capital. We want to manage or understand any treasury stock and the retained earnings, as well as prior period adjustments. When we're understanding the objectives of the owner's equity, we're still focusing on the inherent risk, control risk, and the detection risk. Okay, and the detection risk is where we are determining the substantive testing that we're going to be doing. So what we're focusing on the substantive testing is the existence of owner equity and the occurrence of related transactions. Cutoff, determine that the client has obligations to pay reported debt. establish the proper valuation of owner's equity and the accuracy of transactions, and then determine the presentation and disclosure are appropriate. So we're concerned with, from capital stock, the authorization by the board, segregation of duties in terms of handling transactions, and maintaining adequate records. We probably will be using an outside party to manage a lot of this. These registrars or stock transfer agents are part of the process. So these external bodies are individuals that we need to understand as we are walking through the audit. Small companies, maintaining stock certificates is not done by an outside organization. It's going to be done by the organization, and we need to understand the proper record keeping and so forth related to this. Okay, so I think we've sort of covered everything that we need to cover related to these 3 chapters. We did have a lot of information, but in any event, I thank everyone for their attendance this evening. We should be able to get this thing out posted fairly quickly. So hang around just for a minute or two if you have any questions. If you don't have any questions, we will continue this discussion, I believe, in 2 weeks. Okay? So I thank you very much, and everybody have a great evening.